Hi, welcome everybody to the webinar for the Brackenfields Property Syndicate with the projected 8% per annum return. I'm Alan Henderson, one of the directors of Erskine and Owen, and with me Simon Paris, who a lot of you will know, our GM of Investor Relations. It's probably going to be about 20-30 minutes of us talking, and along the way we're happy to take any questions that you may have, so just type them in, and in the Q&A section that you'll little module that you'll see on your screen, and we'll keep an eye on that. We've got a few pre-questions as well that we'll work through. So look, we're pretty excited about this offering, given the return and the quality of the asset and the location. So look, we'll jump into it, and so Simon will lead the way, and I'll jump in with comments and as we get going. Across to you, Simon.
Okay, so the agenda for today is we'll just provide some more detailed property information for you, and we'll go through the finance information as well, and then we'll just go through some of our frequently asked questions in regards to the syndicate, and then we'll just open it up to answer some of your burning questions. So thank you again for all being here. Can we run this?
Yeah, you can.
So the site is at 121 Carters Road in Amberley. It's called Brackenfields. We purchased this for 15.3 million, and we got a subsequent registered valuation of 15.5. It's a large site. It's 2.7 hectares in total, and the total net lettable area across those three different buildings is 5,769 square metres. And the total annual rent across all 16 tenants is that 1.377 million. The WALT, if we look at it from the entire 16 tenants in there, is 4.6 years.
So just jumping in on that WALT, that's brought down slightly because of the retail, or the sleeve of retail either side of Countdown. I think what's important to note is that Countdown have got a rights of renewal right through to 2049, which is pretty substantial. And once we sorry, if you just go back to that slide, Simon. Once they get established somewhere, Countdowns, as you will know, are unlikely to move, because as long as they're getting the turnover that they're looking for, I guess, making the profit that they're looking for, they've established themselves there. Why would they want to move? So from our point of view, although the WALT is at 4.6 years, technically that's how we have to calculate it, and yet I'd say, really, to my mind, I look at them as a 2049 tenant, and then we just keep building up those, the other retail side of it. We've had New Zealand Post has been on a 1-year basis, and they've just moved since going unconditional on this deal. They have committed to a larger space, a 4-year lease, and the vendor is paying the 100 grand fit out. So we know that they are secured for a good period of time, and why wouldn't they stay? So, and what I would add is that the vendor underwrite, even though we've pulled Z Post out of and put them into this space, the vendor underwrite switches across to the space that they've vacated. So what it means is that what we negotiated was that if any of these three underwrites that the vendor has provided are tenanted by an existing tenant by vacating another space, the underwrite switches to the vacated property. So that's a question that we've been asked. So I might have stolen Simon's thunder on that, but I'll let him carry on. And perhaps just check if there's any questions at the end of each slide, Simon. So we'll just make sure that we're good to go. So,
all right. Okay, so on the next slide, we just go a bit more granular into Countdown. So that net rent of 669,714, that equates to roughly 50% of the entire income produced from Brackenfields. The floor area of 3,572 equates to about 60% of the total net lettable area on the site. You can see the current lease term is 5.5 years, and the final expiry is 2049. If you look to the bar graph on the right, it just gives you a bit of an indication of the turnover of the countdown. So you can see that in 2017, it was around that 28 mil, and now it's, as of mid last year, it's jumped up to about 34 mil. So that's about a 23% increase in turnover over that term, which we find very encouraging.
Yeah, and I'd add that so the way these turnover rents work is that the turnover of countdown has to hit a certain level before a market rent review kicks in within the current lease term. At the end of this lease term, there's a market rent review, but before that, the rent review is only triggered if they hit the turnover rent, which in this case is 37 million. So if you look at the growth, they're tracking towards it, and it could be that we hit that 37 million sooner rather than later. And I guess the other thing, why would I say that's possible? Simply because of the activity that's going on in Amberley, with there being good residential subdivisions being added in. There's the retirement villages, and it's just that whole story of how Amberley is so accessible to Christchurch. And maybe it's just because I'm an Aucklander and I go, why aren't more people not living here? It's a straight road from Amberley through to Christchurch, easy driving, and it's a 40-minute drive. And the average commute in Auckland, I'm sure, is more than 40 minutes. So that seems like a no-brainer to be able to escape from the office job to Amberley, and you've got the weekend there with all that it has to offer, with the beach and the golf course and the whole environment there and the winery. So that's it's perhaps a slightly naive view, but also maybe not, because as more Aucklanders look to find affordable housing, so especially young professionals, that's resulting in people moving out of Auckland and to places like Christchurch and the Hawke's Bay, where housing's more affordable, and that lifts the population, and then more demand for housing. So, and then keep in mind that the net population growth in New Zealand is about 100,000 to June, and they all have to live somewhere. Now, admittedly, historically, 2/3 of my net migration ends up in Auckland, but that I'd suggest is an initial, it's a sort of a logical place people get here. Auckland's the main airport, but they don't necessarily stay in the long term, and that results in migration out into some of the other cities.
So some of the key features of the Brackenfields is the buildings were built in 2014, and naturally they've got a 100% NBS, which is the earthquake rating score. The site has 3 individual buildings, and across those 3 buildings the 16 tenancies. So that's 15 specialty shops plus the countdown, which takes up the majority of that space. It comes with 383 car parks to ensure that there's sufficient parking available for all of those tenancies. Just some further notes is that that's the large road down there, that's State Highway 1. So it's got road frontage to there, which is very beneficial. If you look at that arrow to the right of the site, that's actually, I think it's 1,000 square meters?
Roughly, yeah, 800 to 1,000 squares.
Of unutilized space. So, there is future development potential available in that site. And again, that's another possibility for some value uplift. Naturally, it's the only supermarket.
Can I just jump in on that,
sure.
Simon? So yeah, on that, I guess it begs the question, what would we do with that? What's the natural best use? There is a petrol station not far from there, but it's a manned petrol station, so possibly another petrol station that's unmanned. We have had somebody approach us, a builder wanting to put a show home on there through the vendor. We haven't heard anything from them yet. It's probably not, the land is probably not, it's probably worth $500,000 if it was subdivided, and of course you've got subdivision costs in there, and so so that's in relation to the total value of the complex. You'd argue that it's not that significant, but I guess it's more what we can do with it and adding value down the track. And it would be about attracting a tenant first of all. We wouldn't be spec building anything. Is how I would see pursuing that. Sorry, Simon.
That's right. So the Countdown is the only supermarket in the area. So you have to go either to Kaikoura, which is 135 k's to the north, or to Woodend, which is 25 k's to the south. So it's prime located for the Amberley community, and it's very much a captive audience in there. Not mentioning, I think there's about 11,000 cars that pass by the Brackenfields site every day. So lots of traffic coming through, lots of opportunity there. Again, so it's 45 minutes north of Christchurch. Some interesting statistics that the population has increased by 58.4 in 12 years. Sorry, 54%. And the median value has increased by 118% in 10 years. Like we mentioned before, we've got a number of subdivisions going on around Amberley. The retirement village is there, it's open, and it's taking on people at the moment. And there's a beautiful golf course just along the coast of Amberley to the beach. So some great little things to note about how Amberley is growing in that Canterbury area. Anything you want to add there?
Yeah, just check questions.
Yeah. Okay. So we'll just jump into the finance aspects of it. So the equity required to raise is 10.943 million. We've secured bank funding from TSB for $6 million. That equates to a loan-to-value ratio of 39% on the purchase price. We've also negotiated a structure whereby that debt will be fixed on a fixed rate. At the time of publication, as you can see, there was 8.33. I've subsequently spoken to TSB, and interestingly, that rate has actually gone down a bit. I'm not sure if that's a trend, but it's just something to note. And of course, for that period of time, it will be on interest-only terms.
Yeah, so I guess I speak to probably the $60 million question is, well, yeah, but Simon, what are interest rates going to do? And I can tell you with 100% certainty that they're going to come down next week. No, I can't. Obviously, we don't know what they're going to do, but we know that the Reserve Bank has signalled that we're at the top of this interest rate cycle. Obviously, there's an announcement this afternoon. Most economists are picking that there's only a 10% chance that the rate could go up. In this environment, obviously, anything could happen. Could it go up by, if it's going to go up, I couldn't imagine it going up by 25%, more than 25% basis points or 0.25%, which doesn't kill us at all. So we've got fat in there to be able to handle that. However, what I really wanted to point out is that if we are indeed at the top of the market or top of the interest rate cycle, as the interest rates start coming down over time, then obviously that's going to slowly improve the return on this. So we're achieving 8% on this at the moment, but over a longer period of time, and obviously property is a great long-term investment, and that's how it should be viewed, is that we should really only be expecting this return to steadily get better over time. So that's what our numbers tell us as we forecast out over 5 to 10 years. So people are very understandably, let's be honest, people are understandably watching and waiting to see what happens with interest rates, and part of that will be the election. Obviously, next Saturday, there's early voting that's opened up now, and hand in hand with that, I suspect goes the question about what happens if with the election and the results. Your guess is probably as good as mine. My guess is that it's a fairly informed guess, I suppose, that we're going to have a change of government. That's certainly the way the polls are pointing, and with that comes a different approach. And I think there'll be a lot of support to see those interest rates. We definitely need to fight inflation, but interest rates come back down. So that's not what everything I've just said is not a statement of fact. It's just my opinion. And but certainly, if I had $30 million or $100 million, what would I be doing? I'd be going out and buying assets like this. So I've got to, I mean, keep in mind that, and I hope I'm not stealing your thunder, Simon, but that we've picked this up at a 9% cap rate. So what I'd like to tell you about is that we looked at this property probably 3 years ago when the market was nearing its peak, and we were negotiating around a capitalization rate of, I think it was a 6.25%. We couldn't make the numbers work at that time. So I distinctly remember sitting there at a Christmas function, ducking out to try and get this deal to work 3 years ago, and just couldn't get it there. And here we are 3 years later, and we've paid 9% for it. Why did we pick it? How did we manage to pick it up at 9%? Bearing in mind that it's got a valuation, a cap rate lower than that, which means the value's higher. That's how we've got the margin. We know that there was a property trader that who was the vendor at the time 3 years ago, who since sold to another property trader, who since sold to another property trader, all of whom their skill set has been primarily around trading property in and out fairly quickly. They're not long-term holders. And so one of them's got caught with it. The vendor that we brought off, who has been asked, or pretty much told by his bank to sell quite a number of properties, which is not uncommon with some of these people who are holding large portfolios. Had to sell. There was a deal on it that fell over, and we jumped in pretty quickly, knowing the property. We were able to. That gave the agent confidence that we'd be able to execute, and we were. And so I think we bought really, really well. And so I'm saying 6% because that's where countdowns, like in Auckland, countdowns were selling for around about 4.5% cap rate and 6% in the regions, and that's where they got to. So in this environment, these assets aren't easy to sell to private individuals, because they're struggling to get money at the moment from the banks. But as we know, these things are cyclical. So we're fully expecting as interest rates drop, once again, values go up over time. So not only are we expecting the yield to improve in this, the return on equity, the return that you get, but also the value will pick up as well. So that's always perhaps something to think about. We're probably at the hardest part of this property cycle, and so over the next 3 years, we expect to, as soon as interest rates start to ease, it means that commercial people, everybody can get finance a whole lot easier, because the test rates, or the serviceability starts stacking up better. More people can buy, demand picks up again. So thanks for letting me jump on that.
That's right. Oops. At the end of it, oh no, profit and loss. So this, just to go over the profit and loss. So the gross rental income, year one, 1.397. You can see the funding costs down there. Anything you want to mention on the funding costs?
Just wanted to talk about, you might ask, why is the rent here 20k more than the contracted rent? That's because we know that there are rent increases that we can achieve out of the leases, that there's some rent reviews coming up, so we're really confident about that. And what I would add in here is that we have working for us our GM of property, Jared Halligan, who hasn't joined us for this one. He's has a lot of experience with retail complexes. He has managed a well-known Auckland complex called Eastridge in Auckland for over 16 years before coming to us, and knows how to attract tenants, how to keep them, how to tweak these. One of these things he's passionate about. He's been through the site and really wants to give the branding a bit of a refresh to make it more visible, and just lots of little things to change the foot traffic, just get a better understanding of what locals are looking for in terms of retail, and go and chase those. So one idea is that with the vacancies that we start moving towards medical. That makes a lot of sense because there's quite a few retirees there. So whether it's an optometrist or a dentist, and definitely a more upmarket hair salon, so that people feel that they can stay in Amberley to do that. And so that's really critical. So Jared brings an enormous amount of experience with managing supermarket tenants as well as shopping complexes. So we're pretty excited about that. And one of the other things I'd say about the rental or the occupancy. So I might be jumping the gun, but might as well do it anyway while I'm talking about it. Is that, well, what about those vacancies, or what's going to happen with them? Because this has been owned by largely property traders for the last however many years. To our mind, we're not seeing a lot of evidence historically of it being worked very hard, or those vacancies being worked very hard. In our experience, what would we do? Well, there's been nobody that we know of that's been tasked from Christchurch, any of the big people like Colliers, CBRE, Savills. I've had people chasing me to ask if they can work on the leasing for this, because they've got the networks. They haven't historically, to our mind, been engaged to push tenancies there. And again, if we combine the intention to create a theme, or like a medical theme, along with giving some of the agents from Christchurch a brief, we can't see any reason why it's not feasible to get good tenants in. And so that's where we're pretty excited about it. And then other little things like there used to be an ANZ ATM and the $2 shop. I'm not sure what it's called.
Dollarama.
The Dollarama to the right of the Countdown, but there was some power supply issue, and ANZ got frustrated. So let's fix that. Get them back in. You can get 20 grand a year from a bank, because they earn transaction fees from ATMs, and get them in there. So yeah. Two questions. Sorry, actually, just was there anything else that we needed to say about the P&L? I think that's pretty self-explanatory. Yeah.
So we just listed some of our frequently asked questions, which we may have gone through a number of them already. We've talked about the Countdown turnover. So it changes at 37 million. We've talked about the vacant land and the development potential for that. The status of the vendor underwrites.
Yeah, so as we've got 3-year underwrites, I think we've covered, just to sum that back up. Any tenant coming from another place in the complex, that underwrite switches to the vacated property, and then runs for 3 years. And there's money in trust to cover that, so we don't go to the vendor every month to get that money. It's sitting in trust, and it just depletes. We just take it straight from our solicitor's trust account, and maybe I just need to check it's not the vendor's solicitor's trust account, but regardless, if it's in a solicitor's trust account, it's safe, which is good. And as I said, Jared's pretty excited about getting down there, and he's seeing the potential for it to add value, create a theme. It's what he's good at. Yeah, and that covers off number 4, leasing, the leasing strategy. And we're just there's just lots of opportunity to tighten up leases as well. Again, the existing property manager from Christchurch has been doing a good job, but he can only do so much with the support of the vendor. So we see a lot of opportunity to work those leases. So yeah, 5 refers to Jared, who I've already talked about. So you'll see his mugshot at the end. As I said, ridiculously experienced. He was managing a team of 10 property managers in his last role, and so he's excited about getting across this. Why is the vendor selling? I've talked about that. It's not hard to find out who he is and get the story off multiple people. Look, he's a really from what I've never met him, but from what I understand, a very established property person. But you know, bank rules are bank rules, and although this is not going to ruin him, he's got to get out. So he's probably losing about $3 million on this, I'd imagine. But hey, you know, he's a big guy, big boy, and so why is he selling? The bank's telling him to sell. He's got to right size his portfolio to meet banking requirements, banking rules. Interest rate strategy and forecast. You want to talk to that, Simon?
Yeah. So the reason why we've decided to fix the debt for the term of 3 years is to provide ourselves and our investors some certainty of the cost of interest, obviously, because that's one of the main drivers that affects the yield. We've looked at a lot of forecasts from different economists and banks, etc., and they all tend to gravitate towards that the interest rate or the OCR is going to start dropping in the next 24 months. So we're sort of looking at a 2025 type timeline until we start seeing those rates falling down a bit. And as Alan previously mentioned, as those begin to fall, it just puts more cash flow into the syndication. And that's that's why we've chosen that term, and also to fix it rather than being on what we call a bank bill floating rate, which fluctuates.
Mm.
But now we're just going to open it up to questions.
One question there, I don't know if I've covered that off. It's about does the turnover rent exclude internet sales? No, it doesn't exclude it. So they do have internet shopping at Countdown and Amberley, so click and collect. So they've got the the lockers outside, and you buy online, and you just go and collect your. So that's a positive. Some other Countdown leases exclude internet sales from the turnover, whereas they're not excluded, which is really good. Yeah, so I think we've talked about the interest rates, which has been asked about. Sort of address that. The underwrites, the status, yeah, we've addressed that. So I think the questions that we're getting there, I think we've pretty much covered them all off. But look, what I'd say is that just jump online, jump on the phone to Simon as well, and talk any other questions that you might have through with him. And as I said, look, this is I believe this is a fantastic opportunity that will. Often it feels like these things are like they're there forever, and then you look back in 18 months' time and go, "Wow, I wish I'd invested at that 8% rate because I can't get that anymore." So what's happening at the moment is that a lot of people go, "Well, I can get a bank bond for 6% or whatever," and why? I just think I'll do that because that's good return, and it's nice and secure. Thanks very much. But of course, what happens is that it feels like interest rates dropping are an age away. But funny how things kind of come around quicker than we think. Interest rates start dropping, then bank bond rates start dropping, and do we then get back to the environment where bank not so much term deposits, but bank bonds or whatever they are, bills get back down to 4%, 3%, and all of a sudden, the return you get in your passive income starts to shrink. And so you can argue, and look, it is, I would say, obviously more risky than a bank bond. Any risk analyst would say this is more risky than a bank bond. You make up your own mind. That's fine, but it also offers more reward in the fact that returns should stay up. And like a lot of most syndicators have had to drop returns on their syndicates because interest rates have risen. But we're not anticipating interest rates to rise a whole lot. So, and especially if we're fixing the interest rate for 3 years, then create some certainty at theoretically what is the top of the market. So yeah. So look, thank you for everybody for coming along and joining in on this, and look forward to talking to you all more. And via email, what I often do on these, I sort of absorb and then go away, and then 2 hours later or that night I come up with 10 other questions. So don't hesitate to come back to us if you've got any questions. So thank you for joining, Simon. Anything else?
Yeah, thanks everyone for coming along. We will package up this webinar and send it out to you all, so you've got a copy of that for your reference. I'm always available to have a chat, either by phone or email. And you should have my details in the registration. But look, again, thanks everyone for your time, and we look really forward to working with you guys, with everyone in the future.
Thank you.
Thank you.